Welcome to Trader Talk, where we dish out the latest Wall Street buzz to keep your portfolio sizzling. And guess what? I'm Kenny Polcari, and I'm coming to you live from the Yahoo Finance headquarters here in the heart of New York City, a global hub where deals are made, fortunes are built, and the next market move is always just around the corner. Coming up, I'm going to share my thoughts on OpenAI. I'm going to chat with my very good friend Jim Iuorio, and then I'm going to share my rigatoni al vittorio recipe, one that Jimmy should use in his restaurant, but we'll get to that in a moment. Now, let's get into my big take. Everyone talks about OpenAI like it's another cool tech company pushing out smarter chatbots. That is way too small a frame. What OpenAI is really doing with its investments in AI is building the rails for the next profit machine of the global economy. Think about where the money actually is. It's not just in selling an app, it's in owning the infrastructure, the models, the tools, and the distribution that other companies have to plug into if they want to stay competitive. OpenAI is pouring capital into bigger models, faster training, custom chips and cloud capacity. But the real power move is this. It is turning AI into a utility that everybody else rents. That's not a feature, that's a toll booth. Every time a bank uses AI to underwrite risk, or every time a studio uses AI to generate content, or a startup uses AI to code faster, or a corporation uses AI to automate workflows, someone is paying for those tokens that compute. That API call. OpenAI's investments are designed to make sure that when the world upgrades to AI-first workflows, its pipes are the ones carrying the water. That is recurring, usage-based revenue tied to productivity, not to vibes. For investors, the lesson is not necessarily to buy OpenAI. Most people can't even buy it because it's not publicly traded. The lesson is to look at the ecosystem the same way OpenAI does. Who owns the chips that train these models? Who runs the data centers that power them? Who secures the networks that protect them? Who builds the applications that sit on top? OpenAI is betting that AI will be embedded in everything. Your job is to figure out which public companies are levered to that same reality. The bottom line? OpenAI is not just investing in AI, it's investing in dependence. It wants to be the invisible layer that every serious business sits on. If that bet pays off, the real winners in the market will be the companies that either power that system or successfully ride on top of it, not the ones pretending AI is just another tech cycle. Now, my next guest is one of the most recognizable voices and faces in futures and options trading. Jim Iuorio, who's a veteran trader with over 30 years of experience on the CME floor. Jim has seen every kind of market, booms and busts, and everything in between. He's the managing director at TJM Institutional Services, where he specializes in global markets, interest rates, strategy, risk management, and commodities. Beyond the pit, Jim's a regular market commentator known for his very sharp insights and his no-nonsense personality as he takes on CNBC, Fox Business, and other major outlets. Whether it's bonds, commodities, or the macro trends, when Jim speaks, traders listen. Now, ladies and gentlemen, please join me in welcoming my friend Jim Iuorio to the conversation. Jim, it is a pleasure to have you. I'm just sorry you're not here in the room with me.
Me too. I'm not sure about the no-nonsense part of it. I've heard some of the things I've said, and there is plenty of nonsense. I do like the fashion trend. You put a vowel at the end of someone's name, and all we want to wear is black.
Black.
I don't know. It just makes sense. My closet is the black side and the charcoal gray side.
You're out of your mind. Okay, listen, we got so much to talk about, but I want to first hit you with what's at the top of everyone's mind. This Bitcoin sell-off, right? And its correlation with the market. So talk to me first about the sell-off. Tell me first about, this is now in bear market territory. We've gone from $130,000 a coin. I think it traded as low as $95,000 today. So tell me what you think initially.
If you overlay the charts with Bitcoin and the NASDAQ, we see something that we haven't seen before. Bitcoin was leading the move lower. Now, I don't think, we know that Bitcoin and NASDAQ and all the indexes really are highly correlated. And the reason that that exists is a very fundamental thing. Is from 10 years ago when these big institutions started trading Bitcoin, they threw it to the NASDAQ desk because those guys were used to trading highly volatile instruments, right? So we know the correlation has gone, and believe me, I want the correlation for Bitcoin to go away because it's supposed to be a non-correlated asset, and it certainly is not right now. But what has happened in the past, and remember, the NASDAQ is a $32 trillion market, and Bitcoin crypto at its high was 4.2. So how could Bitcoin be the one leading and dragging the market down? Well, if the implications are that this AI trade, you just talked about the AI trade, the tech trade is stretched, which, by the way, breaking news, of course it's stretched. And to put that in perspective, when the NASDAQ was sitting at its highs, I believe it was last week or maybe 2 weeks ago, the 200-day moving average was almost 16% lower than where we were sitting. That is a stretched move no matter how much. And by the way, I think the AI technology is extremely real. You mentioned OpenAI. And by the way, one of the things that led me to believe that we're in the early stages of the bubble, I know I rant, Kenny. I'll stop in 1 second, I swear to God. But when OpenAI started winking at companies about a month ago, and each one of those companies went up like 10%, that to me smacked of some level of fervor. Just identifying that there's some sort of bubble inflating doesn't mean I know when it's going to end. It means I will trim and trail, keep position size where I'm not going to get crushed if all of a sudden we get a 30% correction, which, by the way, Nvidia corrected 15% in about a week's time, and nobody really batted an eye. So it's a very interesting time to live in.
Right. It's actually interesting, you bring up NVIDIA, and we're going to talk about that. It corrected 15%. It's actually getting to that place where, once again, it's on sale, and it's very interesting to look at, right? And the speed at which it corrected, while it's uncomfortable, I think what people realize is it's not really the end of the world. And look, I know their earnings are coming up next week. I know it's a crowded trade. Everybody's waiting on the edge of their seats. And, it was priced to perfection. They bought it up. And then we had this nervousness in the market that caused, kind of the tech group, the Mag 7 and such, to back off, exacerbated by, I think, this move in Bitcoin. And you have it kind of ripe for a setup. I'm not really sure now, when the earnings come out now, even if they hit every metric on top, instead of, they've already sold it. They may, in fact, come right back in and buy it again.
So let's say this happens. If NVIDIA crushes on every metric, even better than we think it's going to. Again, beating is nothing. They water down earnings estimates and we beat them. It's just kind of the sport. Right. If they beat everything solidly and the market still gets hit, that, to me, will be a big tell of the broader AI trade and the broader tech trade that it's time to take a pause and take some time off. Which, by the way, my base case is that sometimes within the next year and a half, we're going to see a 30% correction. And I've been saying this in the Mag 7, and I've been saying this for about 3 months, which, by the way, we already got 15% in NVIDIA and nobody blinked, like we've already established. So I don't think it's that big a deal when you've talked about the magnitude of these moves higher. It's not that big a deal. But this old saying in the trading world is bulls can make money, bears can make money, but pigs get slaughtered. Meaning, if you're all in and you don't adjust position size, you don't take some profits, you don't realize why God created puts, then you're getting too far over your skis and you're gonna get punched. Yeah. I like it when I tied it up like that. I lost my words and then I just went with that.
Whatever. But wait. But listen, what's happened is, to your point, the NASDAQ has already sold off. I think it was down 8% or 8.5%.
Yeah,
right?
It hit by a little 7, right.
But to your point, it was 16% above the trend line anyway, above its short-term trend line. So it's really not a surprise. And quite honestly, you want to see them shake the branch a little bit because you want to see who falls out.
Yeah, I don't think there's any doubt at all. And by the way, we at unfilteredinvestor.com, as far as portfolio construction and long-term, what we look at is the 8 and the 21 exponential moving averages on the weekly bars. Okay, right. What the market has done is it's come into that level and now it's threatening to back out between those. That'll be a significant sign of strength if it finishes today, which, by the way, does 23,350 some? What's a big handle on the NASDAQ? Is it 23,000?
I don't have the chart in front
Whatever.
of me.
I think it's 23,000. Whatever the big handle is, about 100 points higher from where we are at this moment is about 23,350. A settlement above there, and then any sort of subsequent strength on Monday. To me, it'll mean technically that we're still strong. Now, Nvidia can come and slap that whole thing in the face if it comes out terrible, or if there's lots of longs that are looking for exits, and all of a sudden we can be back in a volatile stage. But I actually think that the movement of the last 2 days, particularly the rejection of the lows today, leads me to believe that the whole thing's not over yet.
But let me ask you one quick question. Just go back to Bitcoin for 1 minute, because now it's in bear market territory. It's down 20%. I think it's down a little bit more than 20%. What does that mean to you? Does that mean anything to you? Does that mean you think it's going down further? Do you think it's going to churn a little bit? Because we're down below all three trend lines now.
The only thing that it means to me is that it was a moment in time where the market, the broad market, was reevaluating risk. Yeah, I mean, volatility's been relatively low, which, by the way, 2025, after I said that, 2025 is running a base level of volatility that's a little higher than normal years. And I think having the human headline bomb in the president's office is part of that. 0 days to expiration options is part of keeping volatility a little elevated. But anyway, risk had been kind of underappreciated up until this week a little bit. And all of a sudden you have to shake things up a little bit. And it started with Bitcoin. Bitcoin really is the tip of the spear as far as risk asset goes. Everyone, was billed as this non-correlated asset that's a hedge against fiat currency stewardship. Poor fiat currency stewardship, but it's not really that. It's just turned out to be the top single risk asset. So when all of a sudden moods started to change, boom, we started hitting Bitcoin. And then once, as you've seen before, selling can beget selling, and then all of a sudden becomes into a sloppy trade.
Okay, hold on there 1 second. We're going to take a break. We'll be right back. Welcome back, Jimmy. I want to talk about something else with you, because we talked about Bitcoin. We kind of talked about Nvidia and the AI trade and all that stuff. I want to talk to you about gold, because gold's another thing that you love to talk about. Now, we've seen it, trade all the way up to 46.50 or 46.50 was the high, I think, right?
I thought it was 44.50, but it was up
44,
there. Yeah,
44.50. It was up. Some of it was up there, right? It's now trading it's backed off. It's trading down to 4,000 recently, right? Talk to me first about why you think we've seen this exponential move higher in gold.
Okay, so I think it's a three-pronged thing. I think it begins with central banks buying gold, and that's kind of accelerated in 2022 when we froze Russia out of the SWIFT payment system, when we froze up their dollar-denominated assets. This is not any sort of political commentary at all. This is commentary on policy and how the world might think of the U.S. as the arbiter of world's trade. So it makes it's very reasonable that they would say, if they can do that to Russia, perhaps they could do it to us. So let's start to hedge our bets a little bit. Now, to put it in perspective, in 2017, 64% of the world's reserves were held in dollars and U.S. treasuries. Now that number's gone down to 57%. So that's it. So central banks are buying because of the stewardship. Secondly, when Donald Trump gets into office, all of a sudden global trade starts to get kind of knocked on its ear. So the question then becomes, okay, if U.S. is going to be a problem in global trade, should we buy a little more gold? The answer to that is probably yes. Third, we keep spending money like drunken sailors. The administration before this and the administration now. And so the debasement trade, I don't care who's tired of hearing it. The debasement trade is real. And yes, Jerome Powell sounded a little hawkish at the October 29th meeting, but it was literally the same week that the president started talking about throwing $2,000 checks to everybody. Are you going to sell gold when 2,000 checks are going out? Which, by the way, I don't think $2,000 checks are going out. I think he wanted to frame the Supreme Court decision as the Supreme Court against the will of the American people. And what's a better way to get the American people on board? To promise them $2,000. I don't think it's ever going to happen. So what could the downside of gold be? Well, let's picture Trump and Xi holding hands, a trade deal actually signed, and an implicit promise that they're going to go back to buying treasuries. That could hurt the gold trade. But I don't anticipate that happening. But I have put on hedges in case of that eventuality. But I'm still long up to the eyeballs in gold. Today's strength in gold after the weakness, to me, seems nice, and I did buy some more calls. Well, I bought back some of the calls I had sold.
Do you think, though, that gold continues into 2026? What's your view? Do you think gold is going to continue to advance? Because, look, it's had a major, over the last 2 years, gold has had a major moves that you don't see in gold, right? Yep. It's up 40%, it's up nearly 40% this year. It was up 30% last year, right? You don't see those kinds of moves in gold. So do you think that continues in 2026?
I thought 2025 was going to be a rocky road, and I hope that the president and the administration gets the fiscal house in order in 2026 and actually starts to reduce deficits. It's a hope, but it's not a base case. I don't believe they'll do that. I think no matter what the administration is, I'm not trying to bash the Trump administration or promote them. I just think it's much easier to talk about cutting spending than it is to cut spending.
Right.
So I don't think they're going to do that. And I think the gold trade continues. But again, you have to ask yourself, is the global geopolitical risks all going to all of a sudden go away? And I don't think the answer to that is yes either. So I'm going to plan to be comfortably long gold. I actually think now, a speech I just gave in New Orleans last week, I think it's time now to own the physical, And then if you are not that bullish on it, you hedge it in the paper markets as well. But I think if it continues moving like it has, it'll be indicative of a real problem in this country. Again, not my base case, but it's possible.
Right, but I think that's really the key that I was looking for, is that it is going to point to a bigger problem in U.S. spending, in the U.S. economy, and kind of the role that we play. And I
You think that has happened already, right?
Well, I think it's happening, right? I do think that it's starting to lean that way. Now, let's see what happens over the next couple of months. We'll see how it reacts. But I'm in your camp. I still think you got to be long gold. I think you have to have some exposure to gold because I do think it continues to go higher from here. All right, so let's talk about the other thing that Trump is floating just recently. He was talking about 50-year mortgages. Tell me what you think about 50-year mortgages, because I'm not in the camp that it does anything.
Okay, so Thomas Sowell, there are no solutions, there are only trade-offs. He's one of my favorite economists, and he says things all the time. Is 50-year mortgages a dumb idea? The answer to that is yes, but it's also can be no as well. It is this exact same trade as the interest-only mortgages that were in 2005. Now, we know that people weren't disciplined enough and didn't have the right command of their finances to use those responsibly. And I'm certain that will happen again. But is it the president's job or our job or anyone's job to keep a fool and his money from parting? No, it is another tool. And if a person can't get into the housing market and they fully believe that M2 money supply is still going to keep going through the roof, that irresponsibility of the currency is still going to happen, and that real estate is going to be the place to be, then a 50-year mortgage, and if they're right, a 50-year mortgage is not that bad a thing, because the appreciation you'll be making on your home will make it up. It's generally speaking, it's not a great idea though.
Okay, and so we already talked about the tariff dividend. You don't think that's a good idea, the $2,000 dividend? And I agree with you. I think they should take the money. We should pay down the debt. That's what I think we should do. Right?
Yeah.
I don't think he should now, but I also understand, to your point, we're coming into a midterm election year, and he wants, if it gives everyone $2,000, look at me. It's the same way the Bidens gave everybody all that money they gave them, the $1,400 and the $1,400 and the $4,000. They kept just giving them money. Right?
Still waiting for my check, Kenny. Still waiting for mine.
Yeah, I know. So am I. Mine never hit my bank account. I don't know why. But one way or the other, I agree with you. I don't think that he should be using that check for that. I think he should be using using that money to pay down the debt. That's what I think he should do. Talk to me about the Fed. Let's talk about that next, because we had some hawkish commentary coming out of Susan Collins, who basically said, "I'm a no vote." You had the guy from St. Louis, Alberto Mussolini, who said he's not going to be so quick. Beth Hammack said that she thinks rates should remain a little bit restrictive because inflation is still too high. So talk to me where you sit on that.
60% of the people in this country who are the non-asset holders are fully in a recession already and have been probably for about a year.
Right.
The 30% who are the major asset holders are still out spending money and YOLOing. And asset prices keep going higher, even despite the stocks movement of the last couple of days. Jerome Powell can't fix that disparity. So what is it? He either has to worry about the inflation part of it or worry about the labor market part of it, which again, is AI, I think, is disrupting the labor market already. I don't think a lot of these layoffs are that bad, but I think these companies are saying they're going to delay hiring to see what kind of efficiencies and productivity gains they can have with AI. I think that's affecting the labor market. I think Jerome Powell looks at that. Now, I also think he's putting his chips on the hope square, which hopes that AI itself will bring down inflation by disrupting the labor market, hopes that supply-side solutions coming out of the government as far as like encouraging companies to produce by lowering regulation will handle inflation. And I agree with that. I think 2026, there's not going to be an inflation problem.
I think if they continue to cut rates, I think we'll have an inflation problem. But I think if they don't, if they hold it, look, I think they're going to cut them 25 basis points in December. I think while you're getting some hawkish commentary, I still think they're going to cut 25. Then I think at the very least, they need to hold that there. I don't think I am not in the camp that they need to cut beyond that at the moment.
Sure. But when he said on the 29th, the words he said to me seem like they were the same words he says all the time. Data dependent, no decision's been made yet, because that he has to say those things.
Right. That's
I didn't even view it as hawkish as the market did. But right now, the futures market is saying it's a coin flip 50-50 whether or not he cuts. I still think he'll cut.
I think he's going to cut. I think actually, I mean, we were much higher. I think the percentage is 50-50 right now, right? That 50-50 that we're going to get, right, a cut or no cut. I think we're getting a cut. I do think in the end, I think the voices against it made their statement, but I think when they get together, the majority rule is going to say cut.
And our job, by the way, is not to say what he should do. Our job is to try to predict what he is going to do and then how markets are going to react. It's a lot of fun talking about what he should do. And if the president ever wants to tap Kenny and I on the shoulder to be his head of the Fed, we'll probably do it. I'll have to talk Kenny. He'll have to take a pay cut, but we'll try.
All right, so listen, I could talk to you about this for so much longer, but we're going to run out of time, and I want to get to my recipe. Rigatoni al Vittorio, right? It's not just a pasta dish. It's really about a memory, right? This is the kind that sits quietly in the corners of your childhood mind until a smell or a sound or a simmering pot suddenly brings it right back into your mind, right? The story is about a young man named Vittorio who grew up in the seaside town of Puglia, the youngest of 5 children in a family that really didn't have much, but somehow always had enough. Money was tight, but the tomatoes were plentiful, and that's really what this is about. You could always count on the garden, right? On the hot summer days, Vittorio's mother would stand at the stove with a pot of tomatoes quietly bubbling away. Garlic cloves would hiss in the olive oil, and the shallots would soften the taste, and the house would fill with the smell. Jimmy, you understand what I mean, but the house...
Every word of it.
Right? And it wrapped it up, and it just told you everything was going to be okay. But when Vittorio grew up, and he took over cooking, he kept her tradition, but he added his own touch. He blended cherry tomatoes into this sauce to create a sauce that was smoother and silkier and more comforting. His small trattoria, barely big enough for 8 people, became a refuge. People came not because the dish was fancy, but because it transported them back to their own childhood, right? To a time in their own kitchen. With their mothers stirring the pots over the summer afternoons. Now, Rigatoni al Vittorio became more than food. It became a reminder that the simplest things like tomatoes, garlic, cheese, pecorino romano cheese can carry the weight of a memory and the warmth of a home. And that every bowl, no matter who makes it or where it's served, carries a little bit of Vittorio's mother in it and maybe a little bit of your own. You can scan the QR code on the full screen for the full recipe, and you can certainly thank me later. Now, that's a wrap for today's Trader Talk, but the conversation continues. Subscribe on Apple Podcasts, Spotify, Amazon Music, or wherever you get your podcasts. You got questions or topics you want me to cover? Email us at tradertalk@yahooinc.com because I'm always listening. Until the next time, stay sharp, stay disciplined, and stay in touch. Take good care.
This content was not intended to be financial advice and should not be used as a substitute for professional financial services.